You spot a clear trend line. The price pulls back, touches the line perfectly, and you enter your trade, assuming the line will hold. But instead of bouncing, the price blows right through your level. Your stop loss gets hit, and the setup collapses. Entering a trade solely because the price touches a diagonal line is a gamble. To find high probability setups, you have to verify that the market's momentum has actually shifted in your favor before you put your money on the line. We fix this by following a strict three-part sequence. Step 1, drawing imperfect trend lines. Step 2, identifying areas of high confluence. And Step 3, using multi-timeframe analysis to confirm your entry. By combining these 3 specific steps, you stop guessing at abstract boundaries and start executing trades based on the market's internal structure. This chart shows a daily timeframe with a clear moving downtrend. We can clearly see the price making a descending staircase pattern, establishing consecutive swing highs and swing lows. We always want to trade with this dominant market direction. We grab the line drawing tool and connect a minimum of 2 swing highs along the top of the price action. Notice how the line does not align perfectly with every single wick tip. We adjust the line so it intentionally cuts through a mix of wicks and candle bodies. The goal is simply to secure the highest amount of touch points possible. We draw them this way because trend lines act as fluid zones of resistance. If you treat them as rigid brick walls, the natural chop of the market will generate false signals. Once you have the most touches, extend it far out into the blank space on the right side of your chart. You want this boundary ready and waiting for when the price eventually makes its way back up. Drawing imperfect, extended lines provides a realistic baseline for the trend. It accommodates normal market volatility while keeping your overall directional bias intact. Next, look left on your chart. Locate a historical support level where the price previously bounced, which has now been broken. Draw a horizontal level originating right from that broken support. In a downtrend, old support often flips to become new resistance. Look at where your new horizontal resistance crosses the diagonal trend line. This intersection is an area of high confluence. Multiple types of traders are watching this exact coordinate for short opportunities. We have our trap set. Now we wait patiently for the price to retrace upward and enter this zone. As the price enters the box, we watch closely for a reaction. In this case, we get a hanging candlestick. The long upper wick proves that buyers pushed the price up into our zone, but sellers immediately rejected it. Do not enter a short trade here. Even though the price reacted to the zone, the immediate short-term trend is still moving upward. A reaction does not equal a reversal. Pinpointing confluence and spotting a candlestick rejection creates a highly probable area of interest. But to safely execute the trade, we need proof that the short-term buying pressure is actually dead. To find that definitive proof, we have to look inside the immediate upward momentum using a multi-timeframe switch. We leave the daily timeframe and drop down to the 4-hour chart. The daily chart completely obscures the internal structure of that short-term pullback. This split-screen chart illustrates the difference. On the left, the daily timeframe hides the details. On the right, the 4-hour chart reveals the granular swing highs and swing lows of the immediate uptrend. Draw a new, tight trend line directly underneath these 4-hour swing lows to map the short-term momentum. The trigger we are waiting for is the price physically breaking below this tight boundary. Breaking the line is only half the equation. The price must also form a lower low. Once that candlestick closes and confirms the lower low, this is your signal to execute the short entry. That double confirmation, the broken trend line followed by a structural lower low, verifies that the short-term buying momentum has officially failed. Your short-term trend has now turned bearish, perfectly matching the dominant daily downtrend we mapped at the very beginning. Utilizing the lower time frame allows you to synchronize short-term weakness with long-term momentum, providing a layer of confirmation that blind touches lack. You have taken a risky gamble and engineered it into a calculated, high-probability setup. Because you waited for structural confirmation inside a high-confluence zone, your entry aligns with the larger market flow. The trade follows through and the price drops aggressively in your favor. Increasing the quality of your trades requires patience. Success comes from knowing exactly what a verified setup looks like, and just as importantly, knowing when to pass on a trade that lacks confirmation. If this breakdown helped you see the charts differently, hit the subscribe button, leave a comment below with your questions, and check out the resources in the description to master more advanced entry strategies. You have the framework. Stop guessing, wait for the confirmation, and execute when the data shows the trend is ready to resume. See you in the next one.